Hi, this is Anthony Parent of Parent LLP, the IRS medic. And in this video, I want to talk about 3 basic U.S. international taxation principles. And these are some of the more difficult concepts, but absolutely fundamental that you could easily make a mistake about because they do go against common sense a little bit. And so this is really for anyone who's a U.S.-based investor who's thinking about investing overseas, a U.S. expatriate, or any other person who might have an international exposure who also happens to be a U.S. person as well. So there it is. It's a nice little signpost I made. Just follow the arrows to find the right path. There's a pretty funny joke, I think. I deserve praise for that. Thank you. Anyway, our first principle here is that you really can't, one of the things that you really can't do that you used to be able to do quite easily years ago was to defeat the IRS by moving accounts and assets overseas. So it's not nearly as easy as it was even 10 years ago, and 40 years ago no one would even know about it. So that's one of the things you need to know, that because of a new law called FATCA, here I'm going to underline it right here, FATCA, here we're going to the Wikipedia page right here on FATCA. Because of that, the banks, foreign banks actually have an affirmative duty to inquire if you are a U.S. person, even if you weren't born in the U.S. They're going to see if you have any phone numbers or addresses connected with your account. So that's something to be aware of. And then again, there's something we've talked about a lot, but you might not know this, is there's FBAR penalties, and FBAR is a form that you have to use to, well, now it's called Form 1114 or 114, which they just changed the name from FBAR to 114 because I guess things weren't confusing enough. But there are penalties for failing to report that if you have accounts over $10,000 as well. So it's difficult to avoid the IRS, and it's punitive. So that's really one of the first things you know. And here's the other principle, and this is something I always talk about with a lot of our clients, just sort of the basic unfairness of how the IRS works. The IRS wants to come first, and just because one country does one thing one way, don't expect the same treatment back from the IRS, okay? And here's the example. Let's just say that if you are a U.S. expatriate working in the UK, okay, and if you're not a resident there for 3 consecutive tax years, you're not liable to the United Kingdom for your worldwide income. Whereas if you're a U.S. domiciled individual, immediately, if you're here on an H-1B visa or green card, you become immediately, and here present in the United States, you become immediately liable to the IRS for your worldwide income. And also the penalties for making what could be really innocent mistakes can be pretty significant. And luckily there are new programs like a streamlined OVDP, linked to right here. And here's our page for this. We've gone over some of the eligibility here on our website. Hopefully you're eligible for this. This is definitely the best one out there. If you're not, there's other options that we can certainly help you out with. And our third principles we want to talk about is, international tax shelters used to be pretty easy. And, I think the first thing is we have to think about what is a tax shelter. And a legitimate tax shelter, what it will do is it will allow you to defer your income so that it can grow tax-free, just like a 401k. And so on this blog here, I did put an illustration. And so if we invested $100,000 in 1974 domestically that had a 5% rate of return and a 20% U.S. Tax rate per year, that's going to grow to $495,000 and some change there. Same thing, but only you're deferring 100% of your yearly gains in 74, and just say it grows. By the way, we're growing 40 years in this case. After 40 years, it grows to $738,000. Okay, so there's a big difference. Okay, of course, off of that 738, we have to pay, if we're taking 100% disbursement, we have to pay 20% off of that. But our net is $591.04. So there's a difference that we see. Now, that's not such a huge difference, and you're saying that seems like a lot of trouble to invest domestically. Well, in this example, we're just giving you a 20% domestic rate and a 5% rate of return. But what if we have a higher domestic tax rate and a higher rate of return? Well, then things get magnified. Here's the same $100,000 here in this table, okay? and that same $100,000 with a 10% rate of return, and assume a 35% tax rate, and that becomes a 6.5% rate of return. Just trust me on that. I'm pretty sure I'm right. Well, anyway, after 40 years, that's going to grow to just a little bit over $1.3 million at $100,000. If you're deferring the same thing, look at how much this grows to. It grows to nearly $5.5 million. A huge difference. Now, of course, if you're going to disperse it all, your tax rate is 35%. You're going to have a big tax bill at the end, but your net is 3.5 compared to 1.3. Wow. So we can now really see, why deferral is so awesome, and don't we want to do this? And why isn't everybody doing it? Well, because they passed laws to really get rid of a lot of the advantages of deferral. And in 1962, a law was passed, and this is a technical part. Okay, you've learned the word deferral. You learn what that is, and another technical term you're going to learn would Subpart F rules. And really, Subpart F rules, we'll be talking about those a little bit more, but they're saying if it's a controlled foreign corporation, there's going to be reporting requirements, and also we're not going to let you defer as much. And we're going to show you how those work in a future video. So please subscribe to this channel so you can get that update when it comes through. And this is Anthony Parent of Parent LLP, the IRS Medic, and I thank you for watching.